That's the plan, guys.
And I'm out the following week.
Oh, we can finally do a good podcast.
Oh, how's that possible? You're going to be here.
Courtney would disagree.
Staying out of this.
Yeah, Courtney's very diplomatic. Good on you.
That's my goal, is always get Courtney to make a very opinionated take. Stop her from being diplomatic.
Courtney
That's my one
knows.
goal in the podcast.
Model of diplomacy.
Someone's got to be.
Welcome to the weekly edition of the Payne Points of Wealth podcast, the podcast that addresses all the pain points that come along with creating, growing, and sustaining your wealth. Hosted by the family wealth experts of Payne Capital Management, Bob, Ryan, and Chris Payne. Please send us any questions or comments you may have to questions@paynecm.com. And please enjoy this week's episode.
So guys, I think the biggest debate on Wall Street right now that everyone's talking about is we're supposed to see all this inflation from tariffs, yet we got the inflation number this week and it actually came in less than expected. So Bob, are these economists just like way off? They don't know what they're talking about? Or are we just seeing a delay when it comes to inflation? It's out there. It's just not showing up in the numbers yet.
Well, the only economist I trust is the market. And the market is just saying rates are coming down. We're in a steep yield curve. They're way ahead of the Fed. It doesn't matter what the economists say because, you know, they're all the same. They're all two-handed. On the one hand, if this happens, on the other hand, if that happens, they don't tell you anything. I guess that's how you continue to keep your job if you're an economist or a weatherman or a weather person.
Well, here's the real question. Do you agree with President Donald Trump that Goldman Sachs should fire their head economist? Yes or no, Bob?
Well, I think that I like his thinking. You know, it's like, Chris, if you get a client who doesn't like their performance report, we could just go back and fire somebody in our admin department who created the performance report, right? Whoever put the numbers together. Numbers can't be wrong, right? It's got to be the person adding the numbers in, and they got to be incorrect. The software is wrong. The people operating the software don't know what they're doing.
Dad, you are known for saying that if you don't like the chart, just turn it upside down.
It's true.
Bob's the precursor to Trump.
That's right.
But yeah, no, I think it's a good question here. And Courtney, I'm curious. I mean, what do you think is going to happen here? Is inflation going to go higher? Is it going to go lower? Is it going to stay the same? But clearly, inflation hasn't gone up. Like every economist was telling us back just a couple months ago, as we literally came into the summer. Now we're almost over the summer, and inflation still really hasn't had this big uptick that every economist was predicting.
Well, I think everyone's so focused on the tariff discussion, which is obviously a big piece of this, right? Because everyone's saying, okay, it's not the foreign countries who pay it. It's actually the U.S. consumer who pays it. That is inflationary. That's what people have been saying, which I don't think is wrong. But to Bob's point, you're seeing energy prices coming down. You're seeing a tax bill that just got passed. You're going to see some tax savings that are coming in there that is offsetting or will offset any inflationary impacts. So I think the question is, which outweighs itself. So is it inflationary? Yes, but is there enough offsetting factor to offset that? Currently, that's happening, which is great. So I think inflation probably staying the same from here because I think those things are going to offset each other.
Well, the big question, Chris. So does the Fed cut interest rates given the fact that inflation is, let's call it, at a standstill right now, right? It's not going higher, but it's not really going lower.
Yeah, I mean, I think the Fed will cut rates. The question is how much will they cut? And, if I think they cut too much, I think we probably will see inflation. It's just like last time they cut, we saw longer term rates go up. And, the result of a cut is that it heats the economy up, which is inflationary.
So, Chris, what's the matter? But the bond market doesn't listen to the Federal Reserve Chairman? What's that all about? How can he cut rates and bond yields go up?
Well, Bob, you always said that the Fed doesn't control the bond vigilantes, as you like to say.
This is true. The bond gods control the long-term rates. And right now, and I think they have to cut. I don't think the economy needs it. I don't think the stock market's going to care at this point. The yield curve's definitely steepening, right? We have, shorter-term rates like the 2-year and 5-year under 380 now, and the 10 years 4.25. So, it makes sense that they would cut, not because the economy needs it, not because Trump's putting pressure on the Federal Reserve Chair. It just kind of makes sense when the rest of the yield curves around the world are steep.
Well, that's all good and all, Bob, but I think the problem here too is what Chris said is what if that overstimulates the economy, right? That's maybe the unintended consequence that you may have.
Right. Clearly you didn't get the campaign memo. This is the golden age, right? We're going to have a big booming economy. We're in the roaring 20s. We've got interest rates coming down. We got oil coming down. Earnings estimates are all-time record highs. Why are you worried about stuff we can't control?
Actually, rumor has it Ryan's been calling our financial plans the big, beautiful plans.
That's right. Well, no, I think the part about markets that, right, always amazes me is expect the unexpected, right? Like every economist was focused on one metric. And that seems like what always happens. Remember, it was the inverted yield curve for like 3 years that always predicts that we're going to have a recession, and then we didn't have a recession. And it seemed like everyone was so focused on tariffs are going to cause inflation, but nobody talked about the fact that oil prices were going to plummet, which we know is disinflationary, right? Because if you think about oil, it basically feeds into all sorts of inflation because you use it for transport costs, you use it for running your factory, you use it to drive your car. And I think, Bob, that's kind of really the one variable that nobody has been talking about and really has been a huge offset to the fact that tariffs do add to prices.
Well, they do, but the price of oil is going down right now, guys, and it's going to continue to go down. Now we still have some geopolitical risk, but when those things are resolved or settled, or at least there's some visibility on a ceasefire, you're going to see basically the supply of oil just explode globally. And right now there's a surplus. So oil's low, it's going lower. Once you have a cut in energy cost, that's a tax benefit, tax cut to the global economy. So it's not just the US stock market. Everything's going up right now. I mean, look at China, look at the emerging markets. So they go up every single day. They're making new recovery highs.
No, it's a great point, right? It's not just about tech anymore. And, Courtney, if you look at like small cap stocks, they had a big breakout this week. We've been waiting for small cap stocks to go up for a long time. And a lot of that has to do with the fact that if the Fed cuts interest rates short term, well, a lot of companies, smaller companies, borrow at short term rates. Like, do you think this is the time to get into other places besides the technology trade, which Chris loves so much?
Yeah, it absolutely is. I mean, our viewers, our listeners here are going to be, this is going to be no surprise to them because we talk about this every week, but we don't think AI story is done, but I think there's plenty of other areas of opportunities. And I think small caps are a really interesting one here because this was a really hot topic the end of last year. If you remember, everybody thought small caps were going to be the big thing this year, which so far they haven't been. But the reason behind that was because interest rates coming down is a really good thing for small companies. And also less regulation is a good thing for small companies. And we've been so focused on tariffs, everybody's just thrown that out the window. But now you're starting to see those conversations come back in, which is a really good thing for things like small caps. And so that's where you don't want to just ignore the story and only hear the current headlines. You want to be thinking about what the next headlines are. That's probably what it's going to be.
Yeah, I think what the market's telling what I'm hearing from this wonderful panel here is there's no way in the world that Fed Chairman Jay Powell is not going to cut interest rates, Chris. Do you think there's any world here where Jay Powell says, you know what? Screw the president. I don't care. I'm not cutting rates here. I'm going to make them suffer until I get replaced next spring?
Well, it'd be really funny if he did do that. But no, I don't see that happening. I would say it's almost assured that we'll have a rate cut next month. The question is how much.
Well, clearly, Chris, if he doesn't cut rates, we now have a new Fed governor that's just appointed by the Trump administration, who, if I had to personally design the perfect Fed governor for the Trump administration, it would be the guy that they just appointed. So he's definitely looking for a cut. So you had 2 dissenters at last meeting. You have 3 dissenters. I mean, I think it's just kind of a foregone conclusion that rates going to get cut. But I'm telling you, it really doesn't matter. The market doesn't care right now. It's already priced in. Remember, the market's always looking forward. It's not waiting for the news. And that's why I feel so horrible for people that are sitting there in the money market fund saying, well, still getting 4%. What do I need that crazy risk in the stock market? They're missing the boat completely.
Yeah, 100%. And as those 5% CDs come due that you locked into 2 years ago, you'll be locking in at like 3.5% if the Fed starts cutting. So lots of fuel for the fire, lots of fuel to push the stock market a lot higher. And again, I think the point here is when you're building your portfolio is expect the unexpected, right? There's no all or none strategy that works best. No one would have anticipated, especially these economists, that oil prices would have declined so much this year to offset any negative impact by tariffs. So we just don't know, prepare for anything when it comes to your portfolio.
Guys, I think what Ryan's trying to say is that the Payne principle of wealth is that no one knows, right? No one can predict what's unpredictable. No one can know what's unknowable. And when all the experts, when all the forecasts, are in agreement, we know absolutely something else is going to happen.
Well, I think it's a big question, right now is it a golden age? We're now able to have private equity in our 401ks. And, Bob, I know you're a skeptic of Wall Street. I know sometimes you're cynical when it comes to a lot of these products that Wall Street puts together and offers to the public, especially when it was a product that was only for the quote unquote wealthy. Now, all of a sudden, we're all being democratized for everyone in our 401k plan. So I'm wondering, do you think this is the best thing that's sliced bread to have private equity in our 401ks? Like, is this finally everyone gets access to those amazing products that only institutions could have before?
You're absolutely right, Rye. You accuse me of reading all the time. And what I've been reading lately is that no retail client is screaming to get private credit or private equity in their portfolio. However, every institution, every university, every endowment is begging someone to take that crap off out of their portfolio. They're dying to get it out of there. Yeah. They're so overweighted. And the only real big cheerleader is the firm that's selling it, BlackRock. So, call me a cynic. I guess I am.
All right, I'm gleaning two things here. First, Bob Reed's, which we weren't sure about. Number two, Bob, what you're saying is when institutions are selling something and getting rid of it, and all of a sudden it's being pushed on retail investors, individuals like us, that's usually not the best time to get into something. Is that what I'm hearing?
Yeah, especially if it has a sexy title, right? Like private equity, private credit. It's like, wow, it's an exclusive club. I can't even get into a golf club down in Florida. They got 10-year waiting list, but I can get into this club just by putting $1,000 in my 401k. Man, sign me up.
Well, Corey, is this something you want to have in 401ks for your clients?
This is not. No, I mean, you want things that are low cost. You want things that are going to follow with how the markets are doing. You want things that are not overly speculative. So this was not just private equity. I think also cryptocurrency was part of this as well. And it makes me anxious that we're getting things like Social Security is basically running out of money. Pensions aren't a thing anymore. 401ks are like, that is the future's retirement. If you're going to fill those with really speculative investments, that makes me anxious for the future retirees.
Chris, there's an article in the Journal that talks about how some of these private equity firms were buying businesses at a discounted price, but then marking them up on their books at, in some cases, like a 50% premium to what they just bought it for in the same day. Now, to me, where I come from, they call that financial manipulation. Like that's a little scary to me when you're thinking about, trusting to put money into something like this.
I'm going to coin that legal fraud, because that is actually, believe it or not, completely legal to do that. And, the scariest part is that they actually do disclose it in the prospectus. But I have to tell you, none of my clients, zero, actually sit down and read prospectuses. So yeah, I agree with you, Rye. Like that is complete fraud. It should not be legal. It should not be allowed. And it's not real return.
Chris, I just wrote a script for all the advisors to use. It's like, well, yeah, it's been, last time I checked, it was doing really well. Price hasn't changed. It's really, just look in your statement. It says NA, not available. There's nothing to worry about.
There's that big sign over Bob's office that says Bob's Boiler Room.
Well, I think the problem here too is it's like it goes against everything you want to have in an investment, right? It's illiquid. Again, they can manipulate the price. Literally, you can buy something on the same day and mark it up because we don't know if that's the real market for it or not. It's not like when you in the stock market, it's like a fishbowl, right? The prices are trading every second of the day, so you know exactly what the price is. We know the fees are way higher internally. Of course, you don't see those fees, whether it's 1.5%, 2%, and then they take a percentage of your upside. And, I think from a transparency perspective, like we're talking about right now, there is no transparency. So it just seems like overall, Courtney, this is like maybe one of the worst things that could possibly happen to give people this option. Because I think for most of us, most people don't really understand what they're getting invested in.
And one thing you didn't mention too is the illiquidity factor. So a lot of these, you can only redeem like a small portion of this on like a quarterly basis. So if you want to, for whatever reason, you want to sell this investment, which you bought into, they say, okay, yeah, you can sell just like a portion of it. And then you have to wait a few months and you can do a little more. But what you want in your investment strategy is you want to be able to sell something when it's doing well and buy into something else. And markets can move very fast. You need to be able to sell something and buy something else if you want to, or if you're in an emergency, you need to access your funds. Getting illiquid funds like this is really not a good part of your strategy.
God, you're absolutely right, Court. I mean, I still have a couple of clients down in Florida who had some of these limited partnership real estate deals. Now, they've passed away 10 years ago, but the partnership lives on. There's no liquidity. It's not worth anything except somehow the trustees of the fund want to keep it alive because they're taking out their 2-3% a year in fees. And this, these statements come in, nobody knows what to do with them. And I can just see this being a total nightmare from an estate planning point of view.
So Bob, when did you sell those limited partnerships? Let's just put this in perspective.
These weren't things I sold. These were things I inherited when the clients came in with them. Unfortunately, I'm thinking of one case that the person that sold it to him was a fellow parishioner in their church. Think about that. And when we called him to ask him about the investments, he didn't know a thing about them. He did know how much commission he garnered on the sale, however.
Sounds like it only benefits the general partner.
It is, Chris. You know how it works. You know, my X theory, right? At the beginning of the investment, the investors have all the money and the partner has all the knowledge. At the end of the partnership, the partner has all the money and the investors have all the wisdom.
A painfully learned wisdom, right? A very expensive lesson. And I think right now that's what you have to think about, right? Buyer beware. There's all these new options. Maybe it's crypto, maybe it's private equity, all being available now in your 401k plan. So if you're trying to build your portfolio, especially to live off of it at some point in the future, look, you don't need to be a rocket scientist to figure out if you have something that's not liquid, it's hard to access, the fees are extremely high, there's lack of transparency, that might not be the best investment for your portfolio, especially if you're planning for retirement. As a Payne principle of wealth, we always talk about know what you own and why you own it. Hey, hope you're enjoying the most recent episode of the Payne Points of Wealth podcast. Everything you hear on this podcast, along with some due diligence of your own, can help you get ahead financially literally at any stage of your journey. But if you want a more hands-on approach and you saved over $1 million for your retirement, Bob, Chris, Courtney, and I will run for you our total financial master plan, and we'll do that with no obligation or cost. It's a full holistic review. We literally look at everything. We'll go as far as building you your own personalized financial portal. We'll give you a bird's eye view of your entire financial life and hone in on every financial issue you need to address today, whether it's an income plan for retirement. How do you take Social Security? How do you draw from your portfolio, factor in inflation, and don't run out of money? We'll look at diversification. Markets have been wild over the course of the last couple of months. Has your portfolio been up and down? Or have you been sitting in cash, CDs, money market funds, paralysis by analysis? We'll put together a full investment game plan. We'll show you how to grow your wealth, but most importantly, protect it over the rest of your life. And we'll look at fees and taxes. Wall Street loves to sell you high cost, tax inefficient products, whether it's an annuity, mutual fund, insurance product, structured product. We'll do a deep dive of every investment you own. We'll show you how to reduce the cost and optimize your portfolio for taxes. It's not what you make, it's what you take. You'll get a full tax playbook, and we'll do this full review at no cost. We'll literally go through everything for you, do all the work up front. Simply go to www.paynecm.com/financial plan or click the link below to see if you qualify for a free financial review. All right, it's time for the financial autopsy of the week. This is where we dissect a real financial plan and we point out all the issues and mistakes that you can make when it comes to your financial planning so you don't make the same mistakes. And Courtney, you worked on a case recently. Why don't you break it down for us? Let's get the knives out and do this autopsy.
So this is a case, there's a couple that I'm working with who's in their mid-70s and they are officially fully retiring, no more income coming in. And they have always invested their money in CDs, which right now you're getting over 4%. You're getting over 5% if you invested these a couple of years ago on these bonds, which is great. But the problem is you need to forecast this out into the future. So this is a couple who has more than enough money to live on through their lifetime, but inflation is going to be their biggest problem. And if interest rates start coming down, this may be a big problem for this client.
I always find that like with the investment pendulum, it always swings one way or the other. It's never in the middle. Like it's either too much risk or not enough risk. And it seems like here, Courtney, they're probably not taking enough risk. How do their wealth projections look?
Well, here's what's interesting is this couple has accumulated enough money that they don't need a ton of risk. So like in theory, they could get away with like a 4.5% rate of return, which is great. So then you look at CDs and you say, okay, I'm getting 4.5% here. The problem is that's what you're getting today. And all of their CDs are maturing in less than 2 years from now. And if the Fed starts lowering interest rates, which they're expected to do, what's going to happen is as your bonds mature in the next 3 months, 6 months, 9 months, you may be reinvesting this at less. So while they don't need anything aggressive, you can get 4.5%. If suddenly you're only getting 3% on CDs, their projections don't look as good any longer.
Well, it's worse than that because you pay taxes on that money, right? So you're not getting 4.5%. You have to pay taxes on it. We know inflation is around 3% right now. So when you factor that in, you're actually not making money. And, Chris, look, I think being safe is good, right? You don't want to take too much risk and retired. Would you put all your money in cash right now and sit on the sidelines, especially with the markets at an all-time record high?
Well, if I was managing your money, Ryan, I probably would, but for my own money, no. Yeah, and you made a good point. It's like, you really need your portfolio to overcome the headwinds of inflation. And by sitting in cash, short-term CDs, that's just not going to get you there. And if you don't want to diminish your purchasing power over time, you really need that hedge against inflation, and that's equities.
So, Bob, do you just plow all your money into the S&P 500 now at an all-time record high? Is that the strategy? If you've been sitting in CDs and sitting in cash and you know that the rate may go down?
It just goes to show you guys, Ryan never listens, right? New highs beget new highs, beget new highs, right? That's, trees grow to the sky, right? Remember? But no, I think, Chris and Courtney, you both nailed it on the head. It's that inherent insidious hidden risk of inflation, right? Inflation goes up, whether it's 9% like it was a couple of years ago or down to 3% now, it doesn't go to zero ever. I'm sitting here in New Jersey. I just got my electric bill. It doubled, right? Everybody in New Jersey just got a gigantic inflation shock, right? Because energy costs are going down everywhere in the world, except for in New Jersey, right? So, when you're retired and living on a fixed income, you need to build these what if scenarios into your projections, because you got to look at the worst case, because when in doubt, that's what could happen.
So, Bob, should we factor some solar panels on the roof at the house in New Jersey in your retirement picture?
Well, that could go up in price too, but that's the beauty of it. Right now, you've got an enormous opportunity in the investment markets where, dividend paying stocks are relatively cheap if you look at the rest of the market. And dividend yields have been going up almost every year. I mean, our pipeline index just increased their yield, their actual dividend. This is 3 months in a row. I love that trend.
Well, this goes back to why I don't want to plow all your money to the S&P 500, because it pays like a 1.2% yield, right? And then you're just betting on, and this is one of the other problems, right? You have the one problem of you're taking not enough risk. You have too much money in short-term conservative investments, but you have the other side of the spectrum where your money's all in that growth trade, whether it's the S&P 500, NVIDIA, Mag 7, you name it, and you're paying very little income, and then you're 100% dependent on the market going up, right? And we know trees don't grow to the sky. They can grow high, and this market is growing very high, but it's not going to last forever. But to your point, Bob, right now, if you spread your money out into different places, the dividend yields are extremely attractive right now. You can get those yields of 3-4%, but more importantly, they're going to go up over time, and increasing cash flow investment. And that's what you have to think about with retirement, right? It's, my income needs are going to go up. Is the income of my portfolio going to increase over time? And most people don't have that put away. They don't have it designed that way.
And, we went through a period like this where, rates were coming down dramatically. And a lot of folks who were retired, like your clients, Courtney, they're afraid, right? They're afraid because they've always gone to the bank. They've always get rolled over their CDs. And then suddenly, when CD rates are 1 or 0.5%, they make the big mistake of reaching for yield, right? They go into riskier investments or put it into God forbid, into an annuity. And they're lost forever. So it's really a matter of just stepping out of that comfort zone, or somebody demonstrating to them that they can, giving them permission, to take a little bit of more volatility, not so much risk, because the biggest risk, as we know, is running out of money for these folks.
And Corey, I'm just curious, what was their concern, right? Did they know that sitting in with too much money in cash CDs is not a good strategy? Like, what was the catalyst to sit down with you and start making some decisions, proactive decisions about their money?
There's two big things. One, you hit the nail on the head, is they knew that this isn't a good long-term strategy, especially if income isn't coming in any longer. You need to start to make sure you have income now, but also some inflation hedges in the future. So they knew they needed a better strategy than this. The other thing is they're doing these CDs at their local banks, where as it matures, they will then go shop around physically to the other banks locally in their town and find which one is paying the best interest rates, move money from one bank to another. And they had over 13 different statements from different banks that we had to go through to find all of these. So that was a big thing, was consolidation, where I was saying you can just own all of your CDs in one brokerage account. And as it matures, it just matures into that same account and you can reinvest it. And also we can shop around of all the banks across the country, not just the couple in your town. And they knew that it was just a headache of paperwork, and there's just such a simple solution to that.
How did they react to all this? I mean, what was their, when they looked at all this, I mean, was it like an aha moment? Like, did they feel like this makes sense? I mean, what was the reaction?
I think there's something they knew that they needed, and this strategy is the solution they were looking for. So I don't think this was like I had no idea this was going on. This was saying, I knew this was happening. I need somebody to solve my problem. And I said, okay, well, here's the answers. I mean, this is how you want to do it.
And the problem is it's just a road to losing money, right? This strategy of laddering out short-term CDs. And we said this 2 years ago when rates were at 5%. We're like, look, at some point the Fed is going to cut interest rates. And oh my God, they did. So all of a sudden your 5% went to a 4% rate. And again, if you're listening to this podcast, there's a good chance the Fed's going to cut again. Your 4% is going to go to 3.25%, 3.75%, 3.5%. You're basically sitting there doing nothing, guaranteed that you're going to continually lose money over the cost of living. And that's why you have to be so proactive right now. You can't sit on your hands, because clearly, looking at the last year or two, it's been a horrible decision to wait and see. And I think the same thing's going to happen if you do the same thing again here.
Thanks for listening to the Payne Points of Wealth. Hopefully you found the ideas discussed in this episode valuable and useful for your own financial journey. You can find out more about Bob, Ryan, and Chris's firm, Payne Capital Management, at bebullish.com or through the contact information found in the description of this episode in your podcast player or app. Join us next week for another episode of The Payne Points of Wealth, brought to you by Payne Capital Management. Information provided on today's show is provided for informational purposes only and does not constitute investment, tax, or legal advice. Investment is obtained from sources that are deemed to be reliable, but their accuracy and completeness cannot be guaranteed.